It started with a whisper, a glitch in the system, a trillion-dollar market blinking red on screens no one outside Wall Street watches. You didn't hear a siren, you didn't see a headline, but for a moment, global finance trembled. That's where we begin, right here, right now, at the edge of what you think you know about money, power, and who really pulls the strings. I'm talking about influence so deep it bends governments, shapes elections, and defines your life chances without you ever seeing it. Welcome to the Simple Economic Blueprint. Before we dive in, hit like and subscribe, because what we're unraveling isn't just complex, it's personal. It affects your savings, your job, your future, and most of all, your understanding of how this world works. If you stay curious through the next 10 minutes, you'll see what most experts won't say on camera. We always think money belongs to us. We wake up, we earn, we spend, we save. The familiar clicks of debit cards, the reassuring balance on apps. But that's the surface. There's an entire layer beneath, a hidden engine humming billions of dollars every second. To understand this, imagine a giant river. The water you see on top is your cash, your bank account, your paycheck. But below, there's an immense current, invisible to you, that carries the real power. That current is global capital. It's not owned by any single country. It doesn't live in one vault. It flows through interconnected institutions, unaccountable corridors, and incentives that reward secrecy. Let's start with a story. A few years back, a small European nation faced a financial collapse. Its currency lost half its value in a week. People queued at banks like it was a festival of fear. Politicians blamed reckless spending. The press blamed corruption. But the real culprit wasn't headline-friendly. It was a sudden shift in confidence by major foreign investors who moved money elsewhere, tightening credit, withdrawing capital. Those decisions didn't happen in the country's parliament. They happened in quiet offices in New York, London, and Tokyo. One moment, markets were calm. The next, they weren't. What changed? Perception. And that perception was shaped by a handful of powerful actors with far more influence than any single government. If you imagine the global money system as a game, most people play checkers. Governments think they're playing chess, but the real game is three-dimensional. It takes into account unseen forces like liquidity, leverage, and risk sentiment. Central banks print money, yes. Governments tax and spend, yes, but they don't control the real movers. Large commercial banks, hedge funds with trillions under management, and private investors who operate in the shadows you never see. Here's a simple way to visualize it. Picture three concentric circles. The outer layer is everyday money, checking accounts, savings, credit cards. You touch this every day. The middle layer is what banks and lenders control, loans, mortgages, corporate credit. You sense this through interest rates and approval letters. The innermost circle, invisible and almost never discussed, is institutional capital, sovereign wealth funds, private equity, and multinational banks trading complex derivatives. This inner core is where real decisions are made, and where risk is assessed and reassessed in nanoseconds. Governments talk about interest rates. This inner circle reacts to incentives that don't show up on a policy chart. Look at how governments responded to the last global crisis. They lowered rates, they printed money, they talked about stimulus packages and safety nets. Meanwhile, the largest financial institutions expanded their balance sheets with assets so complex that most analysts call them black boxes. No politician debated them, no public hearing explained them, yet these assets determine who gets credit, which industries thrive, and which economies are left behind. It's not a conspiracy, it's math and incentives. Let's break that down. The biggest banks don't operate like your local branch. They trade instruments like credit default swaps and collateralized debt obligations. These are not products you can hold. They are bets on bets. They are promises layered on promises. When these markets move, they can create or destroy trillions overnight. Governments try to regulate them. They pass laws, but every regulation creates loopholes. Every attempt at transparency leads to more complexity. It's like trying to catch light with a net. The more you reach in, the more it moves out of grasp. Now consider the role of central banks. Most people think central banks are there to protect the economy, but in practice, they are also guardians of market stability. They intervene when markets wobble. They inject liquidity, which is fancy for money support. They buy government bonds. They lower rates. But here's the twist. They act not for voters, but for markets.
When stocks plunge, they fear panic. When credit tightens, they fear contagion. Their mandate is financial stability, but financial stability often means supporting the institutions that pose the greatest risk if they fail. Imagine a bank so large its failure would topple the entire system. You and I can fail, small businesses can fail, but when that bank falters, central banks step in. They offer support that ordinary citizens never see. In 2008, governments bailed out banks with public money while ordinary homeowners faced foreclosures. That's not a political stance. It's a structural consequence of who controls capital flows. Now let's bring in sovereign wealth funds. These are pools of capital owned by nations but often managed with private strategies. They invest across borders. They buy real estate in your city. They take stakes in companies you use daily. Their assets run into the trillions. When they shift direction, markets respond. Yet most people have never heard of them. Not because they are secret, but because they operate in a space where financial literacy rarely reaches. And then there's private equity. It's the quiet claimant of capital that governments don't talk about in public forums. These firms buy companies, restructure them, sometimes strip assets, then sell them for profit. Workers lose pensions, factories close, but the accounts look clean on the balance sheets. Politicians rarely challenge these moves because they're framed as private enterprise, but the capital backing those moves often overlaps with public money via pension funds and sovereign wealth. So what happens when a crisis hits? The usual story is that governments step in to protect citizens, but the real pattern is that governments step in to protect capital structures that, if they collapse, take entire economies with them. That's why governments rarely admit who controls global money, because to admit it would be to acknowledge power they don't fully wield. Here's a human story. A teacher in Michigan is planning retirement. A factory worker in Indonesia is saving for a home.
A small business owner in Texas is trying to expand. All three depend on credit, investment, and economic stability, but none of them sit at the tables where real risk decisions occur. Those tables are in towers with tinted windows. The people there speak in projections, risk-weighted returns, and algorithmic forecasts. Their moves determine whether credit flows to Main Street or Wall Street. This isn't to say governments are powerless. They set rules, they influence markets, but think of them as referees in a sport where the players wrote most of the rules. They can adjust penalties, change timing, and alter uniforms. They cannot change the fundamental incentives driving the teams. And those incentives favor capital mobility and risk optimization over local stability and individual welfare. Let's talk about the impression you might have from the media. Headlines scream about national debt. They scare about inflation. They clamor about deficits. Those are real concerns, but they are often distractions from deeper forces. A national debt sounds scary when framed as a number, but governments with sovereign currencies can borrow in their own currency. The real pressure comes when investors demand higher yields or withdraw funds. That's when the invisible current pulls at the surface. That's when reality intrudes on headlines. Here's an example you can feel. When interest rates rise, your mortgage payments go up. That's tangible, but what's invisible is how those same rate changes affect global portfolios. Suddenly, investments in emerging markets look less attractive. Capital flows back to safer assets. Emerging economies struggle. Local currencies weaken. Import costs rise. Prices go up. You feel inflation at the grocery store, but the root cause traces back to global capital reallocating in milliseconds. And that brings us to the uncomfortable truth. Fear and greed still drive markets more than policy pronouncements. Governments want stability. Investors want a return. Ordinary people want security. These goals don't always align. When they conflict, capital wins, not because it's evil, but because its incentives are clearer and its mobility is total. So what's the long-term consequence? We're watching a slow shift of economic power from democratic accountability toward financial mechanisms that respond to speed, risk, and anonymity. Think of it like this. In the old days, nations fought wars over land and resources. Today, capital can move faster than armies. It can starve a currency, inflate an asset bubble, or trigger a crisis without a single soldier being deployed. These are new battlegrounds. And what does that mean for you? It means your life is shaped by forces few understand. But it also means opportunity exists in understanding those forces. Money is not magic. It is patterns, incentives, and networks. When you see the architecture, you begin to navigate it. You're no longer a passive observer. Before we wrap up, ask yourself this. If global money isn't controlled by any one government, then who sets the rules? Who benefits when rates are low? Who loses when credit tightens? And are these systems designed for your prosperity or merely tolerant of it? Share your thoughts in the comments. Talk with others, because the first step to agency is recognition, not denial. If this video changed how you see money, hit like again and subscribe for deeper explorations of the forces that shape our world. Share this with a friend who still thinks money is only about banks and wallets, because the truth is bigger, stranger, and far more powerful. In the end, the question isn't just who controls global money, it's whether we can understand it well enough to shape our own place within it. What will you do with that insight?